This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, October 25th, and I'm on, as always, with my partner, Dominick Tavella, both of us from Long Island tonight. How are you, Dom?
Doing well, Mike. Good evening. How are you doing?
I'm good. No complaints. Everything's all right. I got my voice back, so I don't know if that's good or bad for people around me.
You held up pretty well last week, so I give you credits for that.
Thank you. I appreciate that. You know, the market held up pretty well as also we were talking to John Deed last week from August about, whether we have a little bit of a rally, and we certainly had a nice one towards the end of the week that is now flowing into the first 2 days of this week. And I feel like I say it all the time. The week always starts out pretty good and kind of peters out at the end. But so far, Dom, the S&P is up about 6% this month. The Dow is up around 10, and the Nasdaq's up about 4 or 5. So far, October, after a brutal September, is looking pretty good.
And you might remember, Mike, we started October not so great.
I know.
So we kind of bottomed out. We've talked about that 3,550 being on the S&P being kind of critical level, and we seem to have bounced off of that. And we're clearly in rally mode right now. But of course, the $1,000,000 question is it a bear market rally where you see some kind of upward momentum for a little while and then it rolls over? Or do we get a year-end rally? Is it too early for that Christmas rally that we historically look for? So we'll see what happens, especially with the Fed decision looming next week.
Is it too early for a Christmas rally? I was in Home Depot over the weekend, and all the Christmas trees are out. So is it too early for a Christmas rally?
Listen, I think you, I, and all of our clients would be thrilled to get any kind of rally, and call it whatever you want. But we have a Fed decision coming on interest rates next week. And, there's a lot of opinions out there about what they're going to do with the interest rate hike going forward, and how much and how often. And of course, continuing inflation data, and all of that makes reading the tea leaves a little bit difficult.
Speaking of the inflation data and speaking of the Fed, I saw an acronym over the weekend, which I forgot even existed. And the writer referred to investment choices as TINA, TINA. And the point was the stock market had this little TINA around it for years, and TINA stands for there is no alternative. And now with the Treasury market rallying and interest rates going up, and we've talked about this in the last few shows, clients do have choices. Clients do have places to hide money. So I think that makes this little rally a little bit more interesting, because, money does not have to flow exclusively into the market if you get 4% on a 1-year Treasury.
Mike, you brought it up in the past. I'm glad you brought it up again. That is absolutely correct. We don't have to necessarily go and buy stocks. Whether it's a 2-year Treasury or ultra short maturity bond ETF or corporate intermediate, there are good, high quality interest bearing vehicles out there, and they act as alternatives to stocks. So for the longest time, you basically invested in the stock market because you just couldn't get any kind of return anywhere else. And of course, that's going to weigh on future returns for the markets, and maybe for a very, very long time. But a stat I brought up earlier today, $5.7 trillion still sitting in money markets, in savings accounts, in bank accounts, and now ultimately has to go somewhere. And where and how aggressively, that'll be the driver probably for the foreseeable future.
Yeah, the other thing that makes me a little nervous as to why the market is going up now. Look, I know the reasons it's going up now. Earnings weren't terrible. There were a couple analysts on Wall Street who are permanent bears who've turned a little bullish. The Treasury market, while rallying, has actually calmed down and cooled off a little bit. So there are some factors you know, you can say, all right, it was overdue. It was too much selling and we're overdue. But I get a little nervous about how much conviction there is. We have the midterm elections in 2 weeks. We have a Fed decision in next week. We have a new CPI coming out in 2 weeks. There's a lot of factors out there right now, Dominic, that could really just pull the rug out from investors in a minute.
And any one of those issues could turn this on a dime, up or down, right?
Mhm.
So I kind of look at these things and go, all right, we can't predict the future, but let's deal with these one at a time. And certainly earnings have been at top of the list. They've actually been pretty decent, not spectacular, and not historically at that 7-8% growth, but 3 to 4, very solid 3 to 4 earnings growth. The GDP number for the third quarter should be positive and better than some economists were expecting. So, you know, the economy is not in horrific shape. It's really not in recession shape. But what the Fed does or continues to do could push it there. And so we're going to knock these pins one at a time and adjust the portfolios accordingly.
You know, and speaking of the Fed, thank God we don't hear every 20 minutes the expression soft landing or hard landing, you know, as it relates to what the Fed's actions will do to the economy. But the truth is, you know, that subtlety is still there, because I think most economists and Wall Street people are resigned to the fact that if we're not already, we're probably going to be in a recession. And, you know, and how long will it last? You know, how deep will it be? And to your point, I think the unemployment numbers and the earnings numbers may give people confidence that if we are in a recession, it's not going to be a prolonged, painful recession like we saw in 2008 and 9.
Yeah, I think you're spot on, Mike. Certainly the economists, the strategists that we pay attention to, you know, it's likely that we see a recession early part of next year. First quarter is traditionally a bad quarter. Second quarter might be bad as well as it was this year. But because of the data you just talked about, especially the strong unemployment numbers, and consumer spending has been really fabulous. American Express talked about year over year consumer spending up 21%. Visa today, consumer spending was over the top. The consumer still wants to spend, but I think they're being very focused on not spending on everything. Inflation is taking a bite out of their budgets.
And, you know, you mentioned Christmas. You know, we are getting into the Christmas holiday season, you know, between now and basically December 23rd, I would say, you know, I think for the retail sales, Dominic, isn't like 70% of retail sales done basically in the next 6 weeks? Some number like that?
They literally plan and survive for all year for this last, we'll call it 30 days, throwing in the Thanksgiving holiday and Black Friday and Cyber Monday. But the last 30 days of the year basically are the significant majority of their sales and honestly their profits, right? After this holiday season, there'll be some retailers that won't even be in business anymore. They'll be done, right? So they're trying to survive to get through it. But we come back to this theme. The consumer has been relatively strong. Look at the airplane seats and capacity. I mean, you can't get on a plane today without every single seat being taken. So as long as the consumer stays healthy, we should be okay, even if we go into a recession, a mild recession, early part of next year.
So tonight's guest is Jake Jolly, who's a CFA, chartered financial analyst and director and senior investment strategist at BNY Mellon. He's been on the show before. He was on in June. He gave us a great take then. And after this break, we'll be back with Jake to get his opinion on all things we covered and other topics. So we'll be right back.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominick Tavella, and our guest this evening, Jake Jolly, who's a CFA and director and senior investment strategist at BNY Mellon. How are you, Jake?
Doing work very well, Mike.
Welcome,
it's great
Jake.
to see you guys again.
Thanks for coming back. So, Jake, I know you were listening in on our open, and as we'll just jump off right from that. is this rally, which has looked pretty good, is this another head fake, or do we have some ingredients here to make this one a little stickier?
Yeah, no, it's a great question. Unfortunately, I think the simple answer is that this is the kind of volatility that we talked about back when I was last on at the start of June. Now we've, I think we can sort of summarize the past months as feeling like we lived, multiple years in the market with just how much volatility we've had. And certainly, from a personal perspective, from our, all of our personal accounts, it's nice to see the market moving the right direction. But unfortunately, I think that the macro outlook, what we're expecting from the Fed, really hasn't changed materially. Certainly, I think you guys mentioned on the intro that earnings have not been quite as bad as expected. So there's a little bit of call it nascent optimism coming through in earnings, but I don't think we should get too optimistic, too over our skis, because certainly, earnings are backwards looking, right? They're telling us more about the economy that we all lived through the last couple of months. And I think most folks would agree, and certainly we'll talk about this and dig into it into the show. But this is really more a question about where the market is going to be in 2023 based on what inflation and the economy, what it looks like when we get there, right? And I think there's still a ton of uncertainty there, but I'm looking forward to going through that with you tonight.
Jake, maybe this is not quite a fair question, but let me throw it out there anyway. Both myself and Mike, we're talking to portfolio managers. We're watching some of these experts on TV on a daily basis. And you really have two camps here where one is really kind of doom and gloom, and the S&P is going to go down another 20%. I mean, pretty dramatic further correction. And then there's the camp that says, no, we're going to be all right. And we've probably have already seen the bottom, and it's not clear sailing, but it'll be a lot better by year end, right? Or some other time frame. Why such diverse, really opposite, strong opinions on what's going on out there?
Yeah, well, I think it really comes from sort of how extreme the shocks have been to the economy, and not just the US economy, but really global economies over the last couple of years, right? We came out of COVID with massive amounts of fiscal and monetary stimulus. We had economies growing well above potential GDP growth last year. So, kind of getting back some of what was lost during COVID in terms of economic activity. And then this year, it was always going to be very difficult because we were getting back to sort of normal growth rates. And as part of that, I think sort of the, public enemy number one became inflation. And that has complicated the outlook considerably. The forecasts for inflation have, by and large been terrible. And that has made the outlook very difficult because one of the most important figures driving financial markets is where policy rates are going to be over the next 6 and 12 months. And that outlook has been changing dramatically throughout this year. So I was taking a look at, what were we expecting from markets when I was last on the show on June 7th? Well, back then, the market expected that the Fed funds rate, so the key policy rate in the US, was going to be about 3% by February of next year. You know what it is now? It's 5%. So that is a 2 whole percentage points being added on to expectations around where the peak in this Fed funds rate is going to be. And why has that evolved? Well, it's because inflation has been much hotter than expected. The labor market has remained very tight, has not loosened up as we might have expected at this point in the hiking cycle. And when you look at really sort of taking a step back, the macro dynamics here, you can't draw a lot of optimism from history. Historically, when policy gets very, very tight, specifically monetary policy, as a means to cool the economy and bring inflation down, oftentimes that has resulted in recessions. And we have not seen that yet. We don't think that we are in a recession right now. We don't expect to be over the next couple months, but we think that there are certainly elevated risks going into next year. Now, why is there this discrepancy between some people saying it's going to be okay, other people saying that it's, end of the world? Well, I think a big part of it is really just that the forecasts have been so varied, and there's so much uncertainty about how the economy will hold up versus how it potentially will not hold up, and how this amount of tightening and the Fed's commitment to bring inflation back down to target, how much pain that ultimately is going to inflict upon the economy. And that to me is really the biggest reason that you're getting this difference among folks who analyze this stuff for a living, is that you can look at the data and say, well, this is a massive amount of tightening we need to have a lot of pain to get things back under control. And if that's the case, equities, which are a growth sensitive asset, are going to be under pressure from here. Whereas if you are more optimistic and you think inflation has peaked, it's going to start coming down, and the Fed is going to be able to take its foot off the brake pedal relatively soon, you might have equities kind of get through this, and not really trade too much lower, right? Let's keep in mind that we're still down about 20% from the peak earlier this year. So we've already, deflated a lot. We've already taken a lot of pain this year. We've obviously had bond portfolios under considerable pressure with rates rising. So there's a lot of reasons to think that we've taken a lot of the pain, and that potentially we get through this relatively quickly and have less pain in 2023. But it really comes down to this question about how painful the recession needs to be to get inflation under control.
So Jake, to your point about the Fed seems to be resolved to get inflation under control. It's going to take them forever to get the CPI at 2%, but they seem resolved that they need inflation to cool off. And on Friday, when the market was up at 600 points at some point, there was a headline on my TV that said market rallying on the hope the Fed will start cutting sooner.
Right.
Does the market really rally 600 points on some potential whisper or fantasy? I mean, so that's what makes me nervous. Is this market rally based on wishful thinking?
Unfortunately, what we've seen throughout this year is that the volatility around expectations around the terminal Fed funds have been driving much of the movement in the equity market. So what we've seen for most of this year has been that as rates have risen, multiples, so price earnings being sort of the main one that people focus on, has come down considerably, right? We started this year at really elevated levels coming out of COVID. Now we are trading kind of more in line with long run averages in terms of forward PE multiples. But I think the concern here is really around, if you think we are heading into a recession, are you comfortable with being at a PE multiple that's, I think right now we're at about 16 times forward earnings for next year. Typically during recessions, you see multiples compress further. Interest rates are probably going to push higher from here. So there's going to be further downward pressure on multiples. And earnings are certainly likely to come under pressure if you do start to see consumer spending and the economy begin to contract next year. So all of those things are still in the future. Now, that doesn't mean that a recession is a foregone conclusion. And I think that is one of the reasons that you're seeing so much volatility in the market, is because there's still this uncertainty about, are we going to get through this while avoiding a recession? So I know you guys don't like the soft versus hard landing. I also don't like that. But I think the market right now is trying to price the possibility of a softish landing, where you have the labor market soften but not crack. So consumer spending sort of continues more or less or stays firm. compared to a sort of downside scenario where you get a more traditional recession, where you do have a couple quarters of negative activity, where you have consumer spending contract, and you have unemployment rise by a meaningful amount, which would certainly have knock-on effects to earnings. So I think right now, unfortunately, we would say that the odds on is for the latter scenario, so a recession in 2023. But we think that there still is some possibility of that sort of softish landing. And right now, I think the market is kind of debating, right? I mean, the market itself is a voting machine. And right now, that is really sort of the push and pull because it's not clear. Nobody really knows. And as the data comes in, we'll have a clearer idea about the trajectory of the economy. But right now, when we look at the last few months and how the economy's held up, it's held up very well, given how much tightening we've seen in such a short amount of time.
In an environment where good news is bad news and bad news is good news, and to your exact last point, the economy has held up pretty well. And since the Fed has this dual mandate between employment and inflation, the fact that the employment numbers have been pretty good, doesn't that kind of give the Fed the get out of jail card, and they basically can continue their interest rate hiking until they see a crack in that number?
Yeah, I mean, this is the reason that the Fed is, between a rock and a hard place, because they do have a dual mandate, but right now the sole focus is on getting inflation under control. If I just want to rattle off a few numbers here, bear with me, but since June, the headline CPI inflation rate on an annualized basis has been 8.6, 9.1, 8.5, 8.3, 8.2, right? If you just heard those, that's not making progress. And unfortunately, if you strip out food and fuel and look at the core numbers, they're even a bit more concerning, right? Because those tend to be a little bit more persistent through time. And you're right. While the labor market is holding up, you're going to continue to have pressure coming through on wages. So wages is really the problem for the Fed right now, if you will. Because they're growing at more than 6% on an annualized basis. And you don't need to have an econ degree to understand that 6% wage growth is inconsistent with getting broad consumer price inflation back down to 2%. That inconsistency through time, right? Companies, the major cost of most businesses is employment costs. You can't be paying your employees 6% more every single year and expect that broad CPI inflation is ever going to get back down to 2%. So unfortunately, that is why the Fed has been continually ratcheting up the rhetoric. I think, sort of the speech that will be remembered is the Jackson Hole speech that Chair Powell gave at the end of August, where he alluded multiple times to Chair Volcker and the actions that the Fed took in the early 1980s about keeping at it, staying the course. And what the last thing the Fed wants to do is have this sort of stutter-start approach to getting inflation under control. So the goal is to get rates to a restrictive level. So that is likely 4.5% by early next year, and try to hold rates there as long as is needed to get inflation under control. And then the big question is, well, will the economy continue to hold up, or are things really going to grind to a halt when you have that rates go to that elevated of a level over such a short period of time?
Jake, we're bumping up against a break, and rather than getting into a new topic, why don't we take it now? So we'll have a quick commercial break, and then we'll come back and we'll finish the conversation.
Lebenthal.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella, and our guest this evening, Jake Jolly, who's a CFA and a director and senior investment strategist at BNY Mellon. Jake, I was in the city on Thursday, had a chance to talk to a chief economist at a fairly large bank, and he took the position that people aren't paying enough attention to the war in Ukraine and the disruption that caused in the supply chain, both in oil and energy and food and grain. And he felt that the Fed was kind of on target. They were acting appropriately. and that kind of came out of clear blue sky. And that was kind of the domino that is what's caused us to be in the shape we are right now. And I honestly haven't heard that position before. I was a little surprised by how strongly he felt about that. I just wanted to know if you had an opinion, what your take would be on that.
Yeah, I mean, I think we have to think about sort of the evolution of inflation over the last couple of years, right? I think as we came out of COVID, right, as we were all locked in our houses, there was this massive switch from services demand to goods demand at the same time that supply chains were disrupted, right? So that put immense pressure on goods prices. So I think early in the sort of, the run up to inflation, it was much more of this sort of supply side story within goods, but that's actually been one of the trends that's been rolling over. We have seen that the goods side of the equation has eased a bit. Supply chains are definitely on the mend. Obviously, Russia's invasion of Ukraine spiked oil prices early in the year. But over the last several months, what we've actually seen is that on a month-on-month basis, we've seen oil prices come down. Now, there's been a little bit of an uptick of late because of actions from OPEC plus. But overall, the supply side has actually been starting to ease back. And I think that the problem and the reason that inflation, and particularly core inflation, right? Because core inflation is the thing that strips out those volatile food and energy prices. Core inflation has been accelerating. And that is more determined by the aggregate demand, which fortunately the Fed does have more control over that. And actually our former Fed chairman, Ben Bernanke, kind of famously many years ago said that the Fed can't pump more oil even if it wanted to, but the things that it can control is aggregate demand. And how does it control aggregate demand? By raising the broad interest rate level in the economy. Now that is sort of a famously blunt tool. And right now we are seeing a Fed use that tool in a pretty blunt way, right? We've had, and we didn't talk about it yet, but when we talked in June, it was right before the first 75 basis point hike from the Fed. And if you recall, that was a bit of a late in the game decision, right? Nobody really expected that they were going to deliver 75 until about 2 days before. Now, subsequently, we've had 2 additional meetings where we each seen 75. We're going to get another 75 next week, most likely. So that is, using Fed policy in a very aggressive way. So I think that if I can kind of get back to your original question, that is the Fed acknowledging that aggregate demand got far ahead of where they would like to have seen it, and that's really the problem. And they have to use their policy tools very aggressively to get on top of it before things sort of spiral out of control, right? And the economic term there, and I kind of was hinting into, is a wage price spiral. And that is that situation that the Fed really wants to avoid, where wages go up and companies have to raise prices, and then employees demand more, so wages go up, and it turns into this pro-cyclical cycle that is very hard to get out of without significant pain for the economy.
Jake, I want to see maybe if we can turn this conversation around a little bit and try to create a positive spin. We have an election coming up in November, and the period after midterms historically has been a pretty good one for the markets. And having a split Congress, and it looks like we're heading in that direction, that's usually a pretty positive environment for equities in the markets. Any chance we can have a year-end rally in here?
Yeah, it is funny, right, that split Congress tends to be a good thing for markets.
Well, they have to compromise. I mean, this is not a terrible scenario, right? They now actually have to compromise to create good legislation, not necessarily politically driven legislation.
And actually, the fun market fact here is that I think going all the way back to 1946. You have not had a 12-month period after the midterms where the market has not been higher 12 months later. Now, the big caveat there is that in most of those periods, we weren't in an economy that was facing inflation that was this high, that had a Fed acting this aggressively. So major caveats to that statistic. But I guess the thing that it reminds me of, and another sort of corollary statistic to that, is that bear markets which we entered in mid-June, right? So when we traded to the lows in June, just below 3,700, we were down more than 20% from the peak at the beginning of January. If you look at all of the bear markets going all the way back to the Great Depression, the market is actually up over the next year on average after it trades into a bear market. Now, that doesn't mean that it's recouped all of its losses, but I think it often surprises people that the market is so resilient, because obviously in a lot of those bear market scenarios or historical instances, I should say, we were in a recession, and yet the market was still higher on average over the next 12-month period. So to me, it's a reminder that even in periods where we get pretty pessimistic about equities, the market does an incredible job of pricing, millions of pieces of information, and is resilient to headwinds that, we can't even really forecast very well into next year. So I think it makes a lot of sense to stay balanced in sort of your view on the market, never be too pessimistic or too optimistic, especially when it comes to equities, because things can be very different than we expect 12 months from now. And I think maybe that statistic that I mentioned about after midterm still holds 12 months. So if we get back together and talk at the end of October next year, we can sort of flip back to this and see what's happened.
So Jake, to your point about bear markets, and I take this as a positive. In other bear markets, we always hear from experts that there has to be that 1 or 2 days of complete capitulation where people just throw in the towel, right? I don't know how many thousands of points a decline that means. Every bear market is different. This market has just been this slow, torturous decline, but we never really have that 1 or 2 days where everything got sold off and everything was just, everything was just terrible. They've been bad days, but we haven't had that 1 day of capitulation. And I'm beginning to feel that we might not, right? That this bear market, we may just, slide down. We never have that 1 day where you say, okay, woo, that was ugly. Now let's start to rebuild.
Yeah, I mean, these things are extremely difficult to time, which is why it's much more sensible to have a long-term plan that you can stick with than trying to be too precise about, making the right call, a few weeks before the market really acknowledges it. But, the other couple of points that I'll mention there is that, historically, when we look at how the market has performed through recessions, the trough in the equity market typically happens during the recession. Now, there's a committee that sits in Boston that is sort of the official committee that defines the start and ends of recessions. You're not going to know that information in real time, right? That gets determined retroactively.
The day of the election, Jake. I'm just being cynical.
There's no cynicism there at all, Mike.
But I think that the takeaway for me is really that, this economy is holding up well. It is certainly not in a recession, despite the fact that we had Q1 and Q2 negative GDP prints on a quarter-on-quarter annualized basis. And that is why next year is really where we see more of the headwinds. Now, that doesn't mean that the equity market can't progress from here, because if policy does end up being less aggressive than is currently priced, that the market is going to see that as a positive. But unfortunately, if we do head into a recession, it's likely that the activity needs to slow further. That's the definition of a recession. And the equity market typically troughs around that point, and doesn't really start to recover until policy pivots. Now, a policy pivot, that term gets thrown around a lot, rather loosely, but the real definition of a policy pivot is when the Fed actually cuts rates. So the Fed, rather than keeping rates high or hiking rates to restrict activity, actually changes tone and wants to accommodate and spur and stimulate the economy. And that's really where we've seen most of the turns and really the enduring bull market begin. in the past. Now, the big caveat for 2023, again, is that it's possible that we avoid a recession. It's possible that we get a bit of below trend growth for a couple quarters. It's possible that the labor market weakens, but we kind of, get through it in a few quarters and activity starts to pick up again at the same time that inflation comes back down to levels that the Fed is going to be comfortable with. So I think that, if I want to put an optimistic spin on it, I think we have to acknowledge that we're dealing with very extreme shocks to the economy that we really haven't seen in multiple decades. So it's difficult to draw too many parallels with the past, because we have just different dynamics playing out now. We have a labor market that is very, very tight. We have, still some tailwinds, I think, pushing us coming out of COVID. And all of those things could make this a situation where we avoid a recession altogether, or, a recession that is pretty mild that we can get through relatively quickly next year.
Jake, maybe if you don't mind, I'd like to follow up on Mike's question. I read an article recently about investor behavior. And it doesn't seem like there's a lot of people out there. Obviously, there's going to be some, but that, I'm going to throw my hands up in the air and get out. It seems like maybe the investors are becoming a little bit more patient and understanding that these things do resolve themselves over time. And, selling at the bottom historically has not been a really good idea. Are you getting any sense of that?
Yeah, I mean, I'll give you, unfortunately, kind of a pessimistic answer to that, which is to say that a lot of folks kind of are out there arguing that investors in recent years have gotten very comfortable with V-shaped recoveries, which is to say when things get pretty nasty out there, the Fed is going to step in and save all of us. And given where inflation is right now, it's hard to see that scenario playing out, because they are very committed to getting inflation under control. So this so-called Fed put is probably wishful thinking. Now, that doesn't mean that there isn't some point where the Fed does change tact. And we do believe that in a recessionary environment, inflation, we've seen historically, does come down quite dramatically at the same time that unemployment rises. But you are right. This sort of full capitulation, everybody throwing up their hands, we haven't seen that this year. And I think part of it is possibly explained by this idea that investors are more confident that the bottom is not going to fall out from the market. But another part of it is kind of getting back to that idea I was discussing earlier, that we don't really know if a recession is a foregone conclusion. We don't think it's odds-on favorite that we're going to avoid recession. But that's something that the market is still trying to price and is doing so in a very volatile way at the moment. But in terms of kind of how you track those things, people often look at the VIX, so the volatility index typically spikes quite aggressively around major points of sell-off. You can also look at the put-call ratio. So that's a measure of investor sentiment, how much downside protection people are out there trying to buy. So these things have not spiked to the levels that we've seen in past periods where the market has troughed.
Jake, we have time for one more point. And what I would say to you is the other thing that Dominick and I have noticed, and we probably talk to 100 clients between the two of us every week, we're not feeling that clients have job insecurity, right? Most recessions, people are generally worried about losing their job. I haven't had a single client tell me that there's whispers, around the water cooler, or, memos coming out, there's going to be job cuts or budget cuts. So do you feel that if people feel a sense of job security, they can be patient with their investments, be patient with their 401ks, and not have that day of capitulation if they feel 6 months, a year from now, they're still going to be gainfully employed?
Yes, but I think that is that is the problem that the Fed is facing, right? Is that to get wages under control, sort of the aggressive way to get it under control is to have unemployment rise and to have people tighten the purse strings because they do start to be concerned for their livelihoods. Now, this is a Fed that has been making the argument that the extreme tightness of the labor market, so they're often referring to the number of job openings relative to the number of folks out there looking for jobs, which is at historically high levels right now. They look at that number and they point to that as evidence that through this tightening, the labor market can actually soften by job openings decreasing without having jobs actually be destroyed, right? And this is why, people always get in trouble when they say this time is different, but that is essentially what they're trying to argue, is that this is a uniquely tight labor market where we can really tighten the screws, that labor is providing a cushion to the economy that is going to allow us to slow things down very aggressively, but not crash the economy. And I think we all hope that is true. But unfortunately, history does not paint a pretty picture for the Fed's ability to quote unquote soft land the economy.
Jake, we have guys like you on and ladies on like you on every week. And every week when these conversations wind down, it just dawns upon me that the economy is just one giant Rubik's Cube. And we don't even want to get the whole thing right. We just want to get the green right.
Mike, I used to stink at those things back then, and I don't think I'm any better right now. So I'll leave it at that.
So Jake, we're out of time. We can't thank you enough. Thanks for unpacking a lot this evening. We really appreciate it.
Happy to do it. Look forward to coming back.
Jake, appreciate it. Yeah, we'd love to have you back. A lot of questions to go still. We'll get you back and continue the conversation.
Thanks, guys.
Dominick and I will be right back with a quick wrap up.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tvela. Dom, we had Jake on in June, did a great job then of just, unpacking a lot of information. And I feel like we covered a lot of ground, but as you said, we could have had him on another 30 minutes because we had so much more that we could have gone into.
And he was terrific, Mike. But again, in all fairness, we're dealing with, we just brought it up, right? A Fed meeting, interest rate hike, election, holiday spending, year-end rally, blah, blah, blah. There's a lot of stuff on the table right now and over a relatively short period of time.
And I think, to me, the immediate concern, worry, apprehension is is this rally sticky? Because we've had a couple of other head fakes and got, hit in the back of the head with a 2x4, whenever we thought it was safe to poke our head out of the ground.
I think that analogy was pretty accurate, Mike.
I love the lumps.
I'm on the record, for saying that I thought this was going to be another bear market rally. I hate that I think that. But if you look at all the things that Jake spoke about, and again, primarily revolving around where the Fed is, where's the incentive for them, at least short term, and that meaning over the next 3 months, to really change their interest rate policy? I don't think it's there, Mike. I'd love it to be there. And I'd love to have a huge rally by December 31st. And we could see some of these losses recouped by the end of the year, but I don't see the dramatic policy change, and therefore I don't see how this doesn't become another head fake.
Jake said it. He said it. Investors have gotten used to a V-shaped recovery. They've gotten used to the Fed saying everything's going to be fine. Here's a little bit more fruit punch. Just calm down. And I don't think investors or the investment media believe the Fed when they say they have this true conviction that they're not going to come off this stance until inflation truly calms down.
Except, Mike, and I'm not trying to be funny about it, when Powell does his interview and says, I'm not changing my mind. Right. And all of a sudden I'm like, oh, wait a minute. He means it this time. Powell means it this time. And then we get there. swoon dive back into the lows. So, the old fool me once, fool me twice. We're going to be extremely cautious through this rally. We are not jumping in head first at the short end of the pool. But, if we can regain some of the values, some of the assets, some of the losses, we'll gladly take it, right, Mike?
Yeah, absolutely. And the other thing that we didn't even talk about, Dom, is because of inflation, the government actually gave people on Social Security a huge pay increase this year. You got an 8% pay increase. They just rejiggered all the numbers that you could save for your retirement. So like you said, it's not all gloom and doom. There are some positives out there. There are some good things. They're not all just headwinds heading into the new year. And we're not even close to the new year. We have 2 more months. Anything can happen. But there have been some decent things that have happened heading into 23 that we can hang our hat on as well.
And look, I know people don't want to be reminded of this, but the S&P is down about 20% for the year. The NASDAQ down about 30. So we already have basically felt and endured a lot of pain. And I'm not saying it can't get worse before it gets better, but we're already a significant way down. And likely the next, landing may not be so soft. It might be an airplane landing on an aircraft carrier in the middle of the storm. But as long as the plane lands and we get out of it safely, we'll be okay.
On that note, Dominic, I believe we are out of time once again. When we see each other, it'll be hard to believe it'll be November. So we will be coming up on the end of the year. But for now, Dom, we are out of time, and we will see everyone down the road.
Have a great evening, all.
Have a good night, everybody.